Revealing my two buy and hold forever stocks. This is what this video is about. I'm going to discuss two stocks that I intend to hold for the very long term with massive upside potential. It's not Amazon, it's not Meta, it's not the big caps, it's not the stocks that you hear about every day on YouTube. I mean, maybe you're sick of these stocks because YouTube is all about like 20 stocks: Palantir, Apple, Google, Nvidia. It's like that's all the videos are about these stocks. So it's nice sometimes to talk about something different. And as you could tell, this is when I get excited because my strategy is mainly investing in stocks that most people have no idea about or they're not really well known. And I buy them for a lesser discount because there's not much excitement. The excitement eventually comes and the market wakes up to their value and these stocks go up. But I have very long-term intentions with these stocks. There's no such thing as forever, but I intend to hold them for the long term. I'm going to talk about two of them here, give you my valuation model, my fair value and everything. And I did buy those stocks like last week, and it is pretty close to the price where it's trading at right now. And this has been an amazing year for me. I'm up over 49% year to date. I did buy the Monday dip. Now I'm way above Monday. I got some amazing opportunities. And as I said, I believe this could have been the bottom. So all I ask from you, if you could please press the like button and let me know what you think in the comments. If you enjoy it, if you don't enjoy it, if you hate them, you love them, let me know what you think. I'm open to all criticism. I reply to all the comments. I argue sometimes with you guys in the comments, but I don't care. I mean, I enjoy reading them and replying to them. So, that's pretty amazing. But before I get into those stocks, both of them are kind of trading at 52-week highs. And I talked about both stocks a few months ago at much lower prices. And even back then, they were trading at 52-week high. But every time I talk about such stocks, I get comments that like, what are you doing, man? Why you talk about stocks at 52-week high? You're not going to get any followers talking about stocks at 52-week high. Why are you doing all these things? And this is because you're focused on the price and not the value. And if this is what you focus on, then don't even watch this video because it's more about the values and the price. And I don't know about you, but for some weird reason, I always made more money buying stocks at 52-week highs than buying them at 52-week lows. And it took me years and years to be comfortable with buying stocks at 52-week highs. And these stocks, I averaged up on them. The first stock, I just bought it last week at 52-week high, and it made even another high. And I had it at much lower prices. But something I noticed is that the market tends to reward stocks or companies that are doing very well. That's why they trade at 52-week high for good reasons, like Nvidia many times and many others. But then you have stocks at 52-week lows that the market is punishing them because they're actually doing something wrong. So unless you believe that whatever they're doing wrong will not continue, you're likely going to lose money buying stocks at 52-week lows. And maybe the momentum is behind the stock at 52-week highs because they're actually doing something right. And this is something you have to understand before you watch them, before you tell me, oh, but it's trading at 52-week highs, we're late to the party. Imagine saying that about Apple in 2012, guys. Like, you have to stop looking at this chart, stop looking at the price, and start focusing on the value. Because if you focus on the chart, you're going to sell too early or you're not even going to buy them. You're never going to hold a 100% gainer because they went up 20% and then you get all emotional and happy and you want to take profits at 20% and the stock has 500% upside because the fundamentals are amazing and the story is just getting started. So you have to stop focusing on the price, focus more on the value. The first stock that I talked about before, I'm going to talk about it again, is LNG, which is Cheniere Energy. I talked about it at $161, $162. And this is what people said, oh, but it's up 5% from the low. And I gave a 20-minute video on the stock. But this is why you cannot be influenced by the price. And I bought the stock then. And now I just bought it last week at $180. I just bought it again. I averaged up on the stock because earnings were absolutely stunning. And I have massive conviction in it. And it just made a new high, sitting at 184. And once I explain to you the fundamentals, you gotta know that, the story is only getting started. And the stock is actually getting cheaper. It's not really getting more expensive because the value is improving. But for Cheniere Energy, they have two massive liquefaction facilities in the United States. They have the largest liquefaction facility platform in the US and the second largest in the world. Maybe you heard about those two terminals. I mean, they're pretty well known. Maybe you see them in the news a lot and in many different places. And they work with all kind of customers from ExxonMobil and Chevron and so many places and so many countries. They ship the natural gas all over the world, but their main two areas are Europe and Asia. Europe has been growing a lot since 2022 when the war happened with Ukraine, and Asia has been recently growing because it's experiencing, it has pretty good demographics in terms of population, in terms of the certain costs over there, in terms of the growth in general, GDP growth. So Asia is growing rapidly, and their demand for natural gas is growing rapidly. But this is not just, you could say, a play on national security in terms of NATO allies and the United States. I mean, I would expect if we have a change in administration that the exports to Europe between the United States and Europe will likely increase, not decrease. But it's not just about, more of a national security concern, but it's also about, clean energy. If you believe in clean energy, if you believe in AI, any kind of innovation, data centers, all these things require massive power. The grid cannot support them. So a lot of those, you could say, data centers, some of them are being powered through nuclear energy, some of them natural gas. So natural gas is also a play on it. And a lot of them will likely be in Asia due to lower cost. And Cheniere Energy ships a lot of the natural gas to Asia. It was their largest market so far. So this is pretty amazing for LNG. Now, whenever I tell you LNG or natural gas, you're gonna freak out. You're gonna look at the chart and tell me, oh, but it's all over the place. These stocks are risky and these stocks are going to zero and they're the worst investments ever. But this is not Cheniere Energy. Cheniere Energy is different from your regular old school natural gas stock that gets so influenced every time Henry Hub goes up and down 50 cents or 20 cents. Cheniere Energy is very different because they have a different business model, and their business model is mainly within liquefaction. They sign long-term contracts, 10, 20, 30, 40-year contracts with different kind of players, and they acquire the natural gas from them at a price related to Henry Hub. So no matter where Henry Hub goes, the same thing is going to be for Cheniere Energy, but then they get their own, you could say, liquefaction fee, and this is where they make higher margins from. And they sign very long-term contract, and the demand is there. This is an example of a contract they just signed on August 5th. It's a very recent one, right after earning. And Gulp has agreed to purchase around 500,000 tons per annum of LNG for 20 years from Cheniere Energy. 20 years at a purchase price indexed to Henry Hub price plus a fixed liquefaction fee. This is where they kind of make the margin. So no matter where Henry Hub really goes, it's not really gonna affect Cheniere Energy's cash flows in a major way. As long as it's above 2 to 2.5, this is where their guidance is based on. But this is what they do. And this delivery is expected to commence in the early 2030s. So they're signing contracts for 2030s before their terminals are even done because they're doing a lot of expansion. This is the kind of, you could say, modes the company has. This is the kind of power this company has. This is the kind of demands that you're saying to sign 20-year contracts that they can commence in 2030 on a facility that hasn't even been completed yet. I mean, this is the stuff I'm talking about. And the average contract for Cheniere Energy, I got it from the investor relations team, I think it's like 30 or 40 years. So they have massive visibility and free cash flow, and they're really shielded from the massive volatility in natural gas prices. In terms of guidance, guidance was stunning, and they did raise guidance. And if you're looking at this stock, you have to look at the distributable cash flow. And it was 2.9 to 3.4. Now it's 3.1 to 3.5. So if you take the mid-range, let's say 3.2 billion. 3.2 billion out of the current market cap of 41 billion, this is around an 8.2% free cash flow yield. So the company right now is trading at an 8.2% free cash flow yield. But this is not the main investment thesis for Cheniere. The main investment thesis is their own guidance, and it's called the 2020 vision. 2020 vision is Cheniere from now to 2027. They want to deploy $20 billion, which is around 50% of the market cap. They want to deploy $20 billion in buybacks, dividends, main different things, and they want to get to $20 per share of distributable cash flow. So they upsize the authorization to $4 billion to 2027. They're trying to repurchase another 10% of LNG's market cap to get to around 200 million shares. They're increasing the dividend 15% in Q4, and they're going to increase it to 20% later the decade, so from now to 2030. and they want to get to 20% payout ratio from a distributable cash flow. So this is also a good dividend growth company for a lot of the dividend investors that watch my channel, and they plan on getting to $20 per share of distributable cash flow by buying back stock, doing many different things, but mainly completing the different stages of their terminal expansion. And as you could look over here, one of the terminals is expected to be completed by 2026. The other one is pretty closer to 2027, mid 2027. They get approval for them, and everything is going on the right track. But for stage 3, if it does get completed by 2026 and they do get to 200 million shares, they expect to get between $20 to $22 in distributable cash flow. And if you do listen to the investor relations, or say, the latest earnings call, I should say, and it was pretty amazing, I recommend you to listen to them. And everything is way ahead of plans. The expansion is way ahead of plans. It could finish up way before 2027. Most likely, they said, in mid 2026. And they seem very conservative in general. They keep raising guidance. They said 2024 was their worst year, and it's going to get much better from here. So if this was their worst year at 8.5% free cash flow yield, imagine what their best year is going to be. But if you look at the $20 DCF, or distributable cash flow per share, now the company is trading at 16 times or 16 times free cash flow. And I believe 16 times is fair. Before, the company used to trade at 13 times because they didn't have such long-term contracts, 20, 30 years, as they have now. They had much more debt. They paid down the debt. They had much more shares. They took the shares down. They started a dividend and they increased the dividend. So that's why it's trading a little bit higher. But even 16 times free cash flow isn't expensive at all. So if I take the 20 DCF and assuming they get there by 2027, although it could be in 2026, but assuming by 2027 we get the 20 of distributable cash flow per share, and we time it by 16 times free cash flow, we get around $320 per share. We divide it by the current price of 184, we get around 73% on the upside. So this is 73% on the upside from Cheniere Energy from now to 2027. So 73% in 3 years. And it could be done by 2026. That could be 70% in 2 to 2.5 years. And even if that doesn't happen, you're still getting an 8.5% free cash flow yield on the stock with 20, 30-year contracts, an amazing management team. And a lot of that stuff, you will look at my video and say, maybe if they don't get there, maybe this will happen, maybe that will happen. But if you listen to the earnings call, I mean, you could tell that they're being extremely conservative, and it will likely end up being much more than 20 distributable cash flow per share. It could be 22 to 25, in my opinion. But I'm taking 20, we're getting around 73% in the upside over the next 3 years. And with the company trading at an 8.5%, free cash flow yield, I think the stock LNG is not expensive at all. It's still cheap. That's why I bought it at 180 after earnings. I averaged up. I increased my cost basis because I just can't own enough of the stock. It's pretty amazing. A lot of visibility. It's a national security kind of investment, you could say, but also an investment on a lot of the stuff within AI and data centers, many different things. So I think the stock is a buy. It's an amazing buy. Although it's not easy to buy stocks at 52-week high, maybe the first time it's not going to be too easy. But that's all I have to say. I focus on the fundamentals. I bought it again at 180, and I think the stock is a buy. All right. Now, my second investment, which is a very long-term one, I talked about it before. I'm going to talk about it again, but I'm going to discuss a few points before I get into this investment. And I talked about it in a video more in depth, and it's called the best investment opportunity that no one is talking about. And the stock was a little bit cheaper, but I still believe it's extremely, extremely cheap for the fundamentals. But my main thesis is on Canada. I own around 3 Canadian stocks in my own portfolio, and I'm extremely bullish on this country that most people hate and most people ignore. But I see a massive change in the country, and it's mainly around the population growth. If you look at the annual population growth, it's been booming from 2021 to 2023. The most out of the G7 in terms of population growth has been Canada. And my thesis is that this will ultimately reflect into GDP growth. If you look at the TSX, especially the TSX Ventures in Canada, it's like flat for like 10 or 15 years. Like it's trading at the same price, I think it's since 2008 or 2010, because Canada hasn't really experienced any massive economic growth. GDP has been slow all over the place. But my thesis is that with more people coming in, productivity and everything is going to increase, and that's ultimately going to make its way into more GDP growth and faster earnings growth, which is going to give Canada a much higher multiple than where it's trading at right now. And that's why I've been finding a lot of opportunities there. And this is starting to play out. If you look at what the IMF has to say, Canada is set to be the fastest growing economy in G7 in 2025. It will now grow by 1.3% this year and 2.4% in 2025. And if this does happen, it's reinforcing my thesis that I'm right, that maybe something has changed in Canada, and these stocks that are trading at such low valuations, they deserve a massive, massive multiple expansion. But the stock that I'm going to talk about, and I talked about it before, is a stock called BDT, Bird Construction. I started buying the stock at $17 and I bought it again last week around $22 per share. So I bought it at 17, I'm buying more at 22. So even myself, I'm averaging up because the company keeps delivering. And yes, maybe it looks like it's up so much, you're late to the party. But once you see the fundamentals, you're going to agree with me that the stock is still extremely, extremely undervalued. But Bird Construction, they're a construction company in Canada. And this is something that I'm extremely bullish on in terms of infrastructure and housing in Canada and also in the United States. But the only problem is in the United States, you have a lot of the infrastructure stocks, even like the cement stocks. If I could show you the cement stock, it's trading at 34 times earnings. 34 times earnings for this cement stock with very little earnings growth, not as much as Bird Construction. If you look at United Rentals is pretty close to 52-week high at a very high multiple for the growth. But why? Because it's such a massive investment team that everyone is putting money into infrastructure spending. And this is the case in the United States, but this is not the case in Canada, which is why I've been invested in some construction stocks, housing stocks in Canada, because I believe someday the market is going to recognize it like it recognized the United States massive infrastructure boom in terms of spending, and it's going to give these stocks a multiple expansion. But for Bird Construction, they have specialties in many different areas. Because a lot of you ask me, what is the moat of Bird Construction? There's so many construction companies, but not all construction companies can build and do LNG terminals and LNG projects. Not all infrastructure companies can win, billions and billions of dollars in nuclear opportunities and build nuclear plants and nuclear stuff and nuclear infrastructure. Not all companies can just come in and do that stuff. But Bird Construction does have the expertise to do so. But in terms of Canada, there's a lot of different investments that's going in many different places, not just housing, but for example, they also need to double the electricity supply for a lot of different things. Canada is taking their carbon neutrality and clean energy stuff much more seriously than the United States. And there's a plan that invests over 160 billion and like 93 billion in incentives by 2034, 2035 per year, and so many different things. And a lot of companies are trying to transition to a net zero emission, and that's why nuclear plants are rising again, because it's clean energy and the solar stuff. And Bird Construction does specialize in a lot of those different things. They also build a lot of things within airports, terminals, and they do many different things. They're very good capital allocators. They keep acquiring companies. They recently acquired this company that's more of a civil kind of infrastructure stuff, which they don't have much exposure to. And they acquired it for dirt cheap. And it's going to add around 10% additional growth for their earnings per share per year. So this is amazing stuff. Last earnings report was absolutely stunning. 27% revenue growth. Net income is up 56% year to date. Or I should say in the last 3 months. Year to date is up 66% over the last 6 months. 66% net income growth. Revenue growth around 27.7%. And the best thing about this company is they do have a backlog. And this backlog has been growing 16% year on year or 18% CAGR. And this is what I pay attention to every single report. Because construction is very cyclical. So I pay attention to the backlog. And as long as the backlog is growing, I'm going to be invested in this company. But if the backlog starts declining to 2, 3 quarters in a row, maybe I start to worry a little bit. But there's just so much in terms of spending in Canada on housing and infrastructure, oil and gas, clean energy stuff, and civil infrastructure, airports. The population is massively booming, and you need to update a lot of that stuff. And that's where the money is going. And Bird is taking a share of those investments. And the backlog is still growing as of August 12th, which is like 5 days ago after earnings. The company exceeded another $575 million of additional backlog. Some of them are a multi-year master service agreements. Those are more of recurring revenues for the next, 3, 4, 5 years for certain things like a nuclear sector in Ontario and other LNG projects. And again, not just any construction company and come in and win nuclear contracts. You need a lot of specialty for that stuff, and it's normally at a very high premiums. And Bird Construction is one of the few companies that can actually pull this off. Now, I showed you this company. It has some kind of a moat within their specialty. It's riding a massive trend in Canada in terms of infrastructure boom, population boom, and a lot of that investment, clean energy, and many different things. And I showed you that the company is growing net income around 65%, I should say 66%, or EPS 59%, revenue 27%. What do you believe this company is trading at? This company is trading at 10 and a half times earnings. Crazy, I know. I bought it at 8 times earnings when I first started buying it. Now it's trading at 10 and a half times earnings. And this is the kind of value you find in Canada that you're not going to find in the United States. You're not going to find them in the Big Seven. You're not going to find all these things. Like Bird, this company, which most people had never heard of, over the last 5 years, up 389%. And this is the kind of stocks I have in my group. I have like 4 or 5 of those with a lot of upside and a lot of things that most people haven't really heard of. And it's not really a value trap. People told me that at $16 and they keep telling me that stuff. As long as the backlog is still growing and everything is still fine, the company is not a value trap. But the main reason is trading at 10 and a half times earnings is mainly 2 reasons, or I should say 3 reasons. The first reason is that the trend in terms of infrastructure boom in Canada hasn't been recognized as much as in the United States. If this company was in the United States and I compared it to US construction companies, US construction companies are trading between 20 to 25 times earnings. And they don't have the backlogs that Bird has, they don't have the specialties that Bird has, and they don't have the growth that Bird Construction actually has. But these companies in the United States, they're trading 20 to 25 times earnings because the trend has gone mainstream and everyone has recognized it and investments went like crazy, but it has yet to be recognized in Canada. This is the first reason. The second reason is the company hasn't been the best historically. So they had bad management before, bad business models, and it's just a lot of bad stuff. And this is why the stock has been flat for years. Like from 2008 to 2021, the stock was flat. But they started doing different things. They changed their business model. And the company is now different from what it used to be. But you still have the kind of recency bias where people say, oh, but they had a bad track record. But yeah, but things have changed and they have been sustained and is going pretty well. This is a second reason. But the third reason, which is one of the main reasons, is the low net income margins, although it's been improving from 1.9% to now 3.1% and expected to be 3.7% for 2025. And that's why net income is growing so much faster than revenues. Revenues 27%, net income 66%. Because net income margin has been expanding and it will likely continue to expand as Bird wins more specialty projects like the civil infrastructure within their new Jacobs acquisition, or maybe a lot of LNG terminals or nuclear, and that stuff has much higher margins. And that's why the margins of Bird Construction, they're increasing. So for me, looking at all that stuff, 10 and a half times earnings, the company will likely grow 10 to 15% over the long term in terms of revenues. I think net income will continue to grow 20%. And I haven't even mentioned the dividend. So I would say, Bird easy 15-20% annual return. And as long as the backlog is growing, I'm going to be in the company. If it does start to decline, maybe I get out. But even though the stock is trading at 52-week highs or pretty close, I still think the stock is a buy. It doesn't mean it can't go down because of recession fears or whatever. But if you're a long-term investor, the fundamentals are fine. And to me, such dips would be a buying opportunity. So this is all I had to say. No financial advice. Thank you for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.